Hi friends, good evening everyone. Welcome back to CAP classes. Today, let us start our discussion in financial management with a new chapter, that is cost of capital. This chapter, cost of capital, is personally my favorite and will give you required insights to understand decision making in a business. So open a new page, first put the heading cost of capital, then I will explain you what is the background, what is the foundation, the basics of cost of capital, and then we will go through various concepts. Okay, so open a new page, put the heading cost of capital. Okay, so before we move further, do you remember in introduction class in the first chapter when we are learning about the basics, introduction, objective and scope of financial management? I told you that the financial management discipline deals with the two basic aspects. Do you remember what are two aspects of financial management? First one is mobilization of resources. Second one is utilization of resources. Mobilization of funds, utilization of funds. Do you remember? So what is the meaning of mobilization of funds? That means whatever the capital that is required to run the business, from which source, in which proportions, at which cost, we will mobilize. You understand? You understand? And then once the funds are ready, how do we utilize them? How do we invest them is the second aspect. So if you consider this financial management as a coin which has two sides, one side, first side deals with acquisition of funds, procurement of funds, mobilization of funds, pooling of resources. Second side is utilization, effective utilization of resources, or what we call investment. Okay, so in the first step, when we are mobilizing resources, what are the questions to be answered? The questions to be answered, are one. If I need, say for example, 10 crores to initiate a project, if I need 10 crores, from which source I procure? So will I go for bank loan, or shall I issue public deposits, or shall I accept public deposits, or shall I issue bonds, or shall I issue debentures? Shall I go for a bank loan or loan from money lenders, or shall I issue rights shares, equity shares, preference shares, or shall I use my reserves? So there are various options you have. Okay, so write down point number one. Point number one. Financial management deals with. See, this is nothing but already what we have learned in first chapter. Just a quick revision to bring the continuity, to make you understand what is the continuation and what is the linkage. I am giving the same point once again. Financial management deals with two basic aspects. They are prepare a diagram. Left hand side, mobilization or procurement or pooling of resources. What is the resource here? Resource here is funds. Okay, second one is effective utilization. Of resources. Okay, now in layman language I'll tell you what is financial management. Okay, there are only two problems in this world. My dad used to tell this. Okay, there are only two problems in this world. One is you don't have money, second one is you have more money. There are only two situations. So there is no human being who tells you that I have exactly enough money. That is rare. So either you don't have money or you have more money. Both of them are problems. Actually, having more money is a bigger problem. So simple. Financial management says, you said option 1, alternative 1, I don't have money, procure it. 2, I have surplus money, utilize it. So isn't it basic common sense? I don't have money, procure it. I have money, what to do? Utilize it. Okay, so left side mobilization or procurement of resources, right side effective utilization of resources. Here we study cost of capital and capital structure. Here we study cost of capital, leverage analysis, capital structure theories. Okay, then utilization of resources. Here we do two things. One is investment decisions, which is nothing but your capital budgeting. Second one is the risk analysis in investment decisions, risk analysis in capital budgeting. Then working capital. Working capital is actually a hybrid process which consists of both financing and investing. Working capital decisions involve both the aspects. How do I generate working capital? How do I utilize working capital for the company's growth? Okay, so this is basically the scope of financial management, if you remember. Okay, now write down point number 2. Point number 1 is the revision of our chapter 1. Now write down point number 2. Point number 2. While making financing decisions, that means while making financing decisions, that is from which source or how to mobilize money. While making financing decisions, that is from which source or how to mobilize money, the following questions have to be answered. The following questions are to be answered. 3. Okay, so what is this? How to procure funds? This is the question. Here, A, which source? So you have equity share capital, you have preference share capital, you have debentures, you have bank loans, you have reserves, and you may have so many other sources. So how to procure funds? You have various sources of finance. These are called various sources of finance, types of finance, which is there in your chapter 2. Okay, so this is A. B. At what cost? C. In what proportions? In what proportions? So in what proportions means capital structure. In what proportions means capital structure. At what cost is cost of capital. At what cost is cost of capital. So basically these are your chapter 2, chapter 4 and 5. Okay, so if you look at our beautiful ICI study material, look here. Chapter 2 is types of financing. Chapter 4 is cost of capital. Chapter 5 is capital structure. So this is your chapter 2. Basically this is your chapter 2. This is your chapter 4. This is your chapter 5. Okay, these are financing decisions. When you go to investing decisions, this is your chapter 6. This is your chapter 7. This is your chapter 9, I guess. No, 8 must be dividend decisions. No, 7, 8 and 10. 7, 8 and 10. 7, 8, 10. In between 9 dividend decisions is there. Okay, now we are dealing with this area. Write down point number 4. Point number 4. What is cost of capital? What is cost of capital? What is cost of capital? Under that, write down A. The term cost of capital refers to the term cost of capital refers to the cost incurred by an entity to acquire or retain or utilize capital. The term cost of capital refers to the cost incurred by an entity to acquire, to retain, to utilize capital. Under that, B. There are various providers of finance. For example, equity shareholders. They provide equity share capital and reserves. Preference shareholders. They provide preference share capital. Okay, then financiers, finance providers. We can say that these are debt holders because we already covered equity in the above 2 lines. So these are debt holders. So who they can be? Bankers. They can be debenture holders. They can be bankers. They can be debenture holders. They can be other lenders of long-term finance. We do not deal with short-term finance in this chapter. Whenever we use the word cost of capital or capital, predominantly we are discussing about long-term capital, not short-term capital. Okay. So other long-term providers of long-term finance can be your holding company, subsidiary company also. Or there can be venture capitalists, or there can be high net worth individuals who invest money in your company. Any type of finance. So now if you look at these people, why do they invest money in your company? Is it a charity? Are you relative? Even if you are relative, why will I give my money to you? Just, think about it. You are borrowing money from State Bank of India. Why State Bank of India needs to give loan to you? It is a commercial activity, right? It is an economic activity. Why, a shareholder invests money in a company? Say, for example, personally, if you take my example, I have shares in many companies. But do I invest money for charity? Say for example, personally, I love Ratan Tata. Okay, I really appreciate. Okay, many people do not like Adani, Ambani. Many people like Tatas. But do you know why? Think about it. Why more people are investing in Reliance Group or Adani Group than how much they invest in Tata Group? Do you know the number of investors or the amount of investment in Adani and Ambani is much higher than that in Tatas? Much higher than that of Birlas. Much higher than that of, Wipro. But you like Wipro Azim Premji Saab, Tata, Ratan Tata Saab, you really value these guys. You really appreciate, respect these guys. Having said that, when you are investing money, it is not out of emotion. It is not out of feeling. It is not out of respect. It is out of a commercial equation called how much of return on investment I get. So always your mind as an investor looks for higher, return on investment. Now, simple, basic equation I'll tell you. Simple basic equation I'll tell you. Imagine I have two bank accounts. Imagine I have two bank accounts. One is State Bank of India, one is ICICI. One is State Bank of India, one is ICICI. Okay, imagine I have 10 lakh rupees surplus cash. Okay, which I do not want to put into equity markets. I just want to keep that in a bank which gives me some interest. Okay, ICICI gives me, say for example, 6.5%. State Bank of India gives me 6%. Just for the sake of numeric example, I'm telling you, these are not real rates, just hypothetically, for the sake of a numeric example in the classroom, I'm telling you randomly. So ICICI gives me 6.5%. State Bank of India gives me 6%. Okay, now both banks are safe. So I do not have any doubt whether ICICI will turn the board and run away from India. No way. So use your common sense. ICICI is as strong as SBI. Okay, so in which bank I will put my money? Now, if I am giving my 10 lakh rupees in the form of fixed deposit to a bank, don't you think I am provider of finance to them? I am provider of finance to them. That 10 lakhs only they will use to give loan to some other person, no? Of course, after SLR, CRR, that is a different story. From the deposits, they have to subtract statutory liquidity ratio and CRR, cash ratio. And then remaining money they can give as a loan to some other borrower. Okay, they earn 10% from that, they give 6.5 to me, and the balance, whatever the spread difference is there, that is their profit. So when I am making a decision to maximize my return on investment, every investor thinks like that only. So how many people are there? Here equity shareholder is there, here preference shareholder is there, here banker is there, here debenture holder is there, other lenders are there. All these people, they expect return on investment. So the return on investment expected by provider of finance is the cost of capital to the company. Oh my God, bold. So the return on their investment expected by the provider of finance is the cost of capital. Because Pavan is expecting 10% dividend, for example, shareholder is expecting 10% dividend, company has to pay. Now you might ask, what happens if company is not paying? Simple, I will sell shares and I will buy in another company. If everybody is selling shares, the company's share market price, market price of the share will fall. So now write down point number C. Point number C. The return on investment expected by the provider of finance is the cost of capital to the company. Cost of capital to the company. Now, simple example I'll give you to make you understand. Say there is one individual, Pavan or Mr. A, and there is State Bank of India. Okay, this is balance sheet of Pavan. This is balance sheet of State Bank of India. Left hand side liabilities, right hand side assets. Traditional format. Okay. Now imagine Pavan has a fixed deposit of 10 lakhs. Pavan has a fixed deposit of 10 lakhs. So I will write that in my assets fixed deposits 10 lakhs. State Bank of India will write that under deposit liability here, Pavan's fixed deposit 10 lakhs. Do you agree? Do you agree? So this is my asset. This is company's liability or equity. Okay. Now what happens? P&L of Pavan, P&L of SBI. So imagine I get 10% from SBI towards interest. Just numeric example, 10%. SBI will not give 10%, that I know. When I receive 10% on 10 lakhs, that will be 1 lakh. So I'll write my interest income 1 lakh on the credit side of my P&L. SBI will write to interest expense. To interest expense 1 lakh paid to Pavan. Okay, so on my asset, I have return on investment. On their liability, they have cost of capital. That's all. So now Pavan and SBI, you can change that to shareholder and company. You can change that to preference shareholder and company. You can change that to debenture holder and company. You can change that to shareholder for retained earnings and company. You can change that to bond holder and company. You can change that to, any depositor, public deposit and company. Venture capital investment and company. Private equity and company. A person who is holding this American depository receipt or global depository receipt or Indian depository receipt or euro convertible bond, whoever it is, there are only two people, one provider of finance, two consumer of finance, the person who is consuming or taking finance. Okay, now try to understand, write down point number 5. Since the company is using the funds of investor, it is bound to pay returns in the form of interest or dividends to providers of finance. Full stop. Important. It may either be explicit or implicit. It may either be explicit or implicit. There can be explicit cost, there can be implicit cost. Sometimes cost is visible, sometimes cost is not visible. Sometimes cost is not visible, but still cost is there. Sometimes it is visible. Okay, say for example, X Limited borrowed money from State Bank of India at 10%. Amount borrowed is 1 crore. X Limited paid 10 lakhs as interest. This 10 lakhs is cost of capital. X Limited borrowed money from State Bank of India at 10%. What is the amount borrowed? 1 crore. So on 1 crore, 10% is 10 lakhs. What is this? Cost of capital. Simple example. Now, because X Limited borrowed money, X Limited has now financial leverage. So the risk of shareholders increases. Why? Because fixed cost, that is interest payable, is a burden. So simple. If the company has more liabilities, it is a risk. That is what we have learned in financial leverage. That is what we call trading on equity, isn't it? To some extent, that is okay. That increases EPS, positive. But beyond that, no, it is burden. Do you remember I frequently use this sentence in my classes? Debt is like salt. If you do not have salt, any dish you make will not be tasty. So salt is required. So debt is required. To run the business, debt is required in many cases. But having said that, Salt is adding taste. If you put 1 kg salt in curry, what will happen? You cannot eat it. You need to just throw it in bin. That's all. If debt is more, company goes into liquidation. 99% of the companies they go into liquidation are because of financial crisis or because of high debt. It is called high leverage, highly levered companies. Gearing, we call gearing, adverse gearing. So globally in US and UK they call it gearing. In India we call it, highly indebted, or we call it in India leverage. Okay, basically leverage and gearing are almost same. Okay, we call in India operating leverage, financial leverage, combined leverage. No, okay, if you are studying CMA US, or if you are studying IFRS, I mean ACCA. Okay, instead of operating leverage, you calculate operating gearing. Instead of financial leverage, they call it financial gearing. But the formula remains same, concept remains same. Okay, now because X Limited borrowed money, the risk of shareholder increases. Fixed cost, that is interest payable, is a burden. So till yesterday, shareholder expected, KE refers to cost of equity, which is shareholder expectation. Shareholder expected 18%. Today, shareholder said, I want 21%. Why? Till yesterday, you are happy with 18% expectation, no? So you go and ask shareholder, hey, dear shareholder, don't be so mean, okay? This is bloody your company, you are the owner. Till yesterday, you are happy with 18% cost of capital. You are expecting only 18% return on investment. Yes. Today, why it has gone up to 21%? Then shareholder says, till yesterday, company is not having any loans. The company borrowed money, 1 crore. So if the company makes a default of paying interest, that will be burden on the company. Or if the company is paying interest, that will be burden on the company. So any side, who's the loser? Shareholder. But the debt might increase the EPS. That is a different story. Even if the debt increases EPS, still shareholder says that increased EPS is mine only. No. You understand shareholder's argument. If the company is earning more money because of this 1 crore, that is mine. Pay me more. If the company is struggling to pay interest, that is unnecessary stress on the company. So I am taking financial risk, pay me more. I don't know. This is the logic. You may say, Pavan sir, cost of equity increased. Hello, hold on. I agree, cost of equity increased, but what is the reason? Debt. So this debt has this explicit cost of capital, which is 10 lakhs, and has implicit cost of capital, which is increase in equity shareholder expectation. Trust me, 99% of the students, and for that matter, many lecturers also, they do not understand what is the meaning of explicit and implicit. It is not expressed and implied. Sometimes cost is expressed, sometimes cost is implied. No, it is not expressed, implied. That concept is also there, but actually this is a different concept. Okay, now coming back to the concept, write down point number 6. Point number 6, cost of capital from the 2 arrow marks down. Cost of capital from the 2 arrow marks down. On the left hand side, specific cost of capital, overall cost of capital. What is specific cost of capital? This refers to cost of capital of an individual source. An individual source of finance. For example, equity. It will have cost of equity. KE, retained earnings or reserves. It has cost of retained earnings, which is represented by KR. In some textbooks they write KS. Reserves in some textbooks, especially global textbooks, if you see, they say KS. Okay, Hongre, Van Hone, this kind of textbooks if you see, or any ACCA textbook if you see, Kaplan BPP, sometimes you will see KS. Okay, even CMA, US textbooks you see, Wiley, these kind of textbooks use KS. So KR, KS, it is cost of retained earnings, 3. Third one is preference shares. Preference shares, we call it cost of preference share capital, KP. 4, debt. 4 is debt. Debt can be debenture, debt can be loans. Okay, it is called cost of debt, represented by KD. So these are individual sources of finance. So when you have equity shares, you will have equity share, cost of equity. When you have reserves, you will have cost of retained earnings. When you have preference shares in your company, when you issue preference shares, shareholders purchased, investors purchased your preference shares, they expect dividends on preference shares, which will turn into cost of preference for you. Similarly, cost of debt. So these are known as individual sources, specific cost of capital. Now, all put together, Pavan sir, I have 10 crore rupees of equity, 5 crore rupees of reserves, 10 crore rupees of preference shares, 5 crore rupees of debt. So my total capital employed is 30 crores. So you have cost of capital of all the separate components. Now total capital employed cost is known as overall cost of capital. So here overall cost of capital is the cost of capital that represents the cost of total capital employed of the firm. This is represented by KO. What is KO? KO stands for overall cost. KO stands for overall cost. This is the weighted average of individual costs, specific cost of capital. That is the reason we call it WACC, weighted average cost of capital, WACC. You understand? So this is cost of capital, ladies and gentlemen. You understand? So before going into cost of debt or explaining, I'll give you the explanation of specific cost of capital. Before that, let us understand what is the importance of this cost of capital. What is the importance of cost of capital? Why do we need cost of capital? So this is point number 7. Point number 7. What is the importance of cost of capital? Okay. Under the write down EA. Under the write down EA. Financial leverage is favorable. In other terms, amount can be borrowed. Only if, you tell me, when can you borrow money? You tell me, when can you borrow money? Only if you can earn more than how much you need to pay. You understand? Only in a situation where you can earn more than how much you need to pay. So financial leverage is favorable, or amount can be borrowed only if return on investment is greater than cost of capital. Return on investment is greater than cost of capital. Pavan sir, what happens if this is not happening? Then simple, don't borrow money. If you borrow money, it will be negative. If you borrow money, it will be negative. So you borrowed money from State Bank of India at 10% and you have invested that in your business. Basic common sense, your business must earn more than 10% so that you can pay 10% to State Bank of India. If your business is not able to generate more than 10%, idiot, why are you borrowing 10% loan? So to make a decision, first I need to understand what is that cost of capital, what is this return on investment. Okay, this cost of capital is KO. This cost of capital is normally KO. This return on investment, normally we calculate EBIT by capital employed into 100. So when you calculate this, it is 18%. When you calculate KO, which is weighted average cost of capital, this is 12.5%. Now you can say, because return on investment is greater, chalo, let me borrow money and do this business venture. Makes sense? Now you understand what is the importance of calculating cost of capital. If you do not calculate cost of capital, you do not know whether to borrow money or no. You do not know whether to accept this project or no. Okay, this is from financing point of view. Now look at the magic. B, investment decisions. B, investment decisions. So this is financing decisions, correct? This is financing decision. Now B is investing decision. Whether to accept a project. Whether to accept a project or no. In capital budgeting, whether to accept a project or no. So when do you accept a project? A project can be accepted. A project can be accepted only if its net present value is positive. Now, how do you calculate this net present value? This net present value, to calculate net present value, cash flows are to be discounted using a rate. To be discounted using a discount rate. Using a discount rate. Now you tell me, what is this discount rate? How do you know this discount rate? Now one innocent student, Chintu, will tell, sir, in the problem they will give discount rate, sir. Arey, rubber manda, in the problem they'll give discount rate. But if you are running a business in real life, who will tell you discount rate? In the problem they said, the company uses a discount rate 12%. Use the discount rate 16%. In the problem they said, but in reality, in real life, how do you know what is the discount rate? This is KO, my dear friend. Oh my gosh. What is this? Investing decision. So, Pavan sir, for financing decisions, cost of capital is important. For investing decisions also, cost of capital is important. Yes. Because a small change in KO can make acceptance of the project to rejection of project to acceptance. This is very crucial. This is very important. So this is point number 2. Point number 3, in dividend decisions also KO is important. Is it? Yeah, obviously. So while making dividend decisions, whether to declare dividend or to retain profits for future growth. Whether to declare dividend or to retain profits for future growth. How a decision is to be made? This is dividend decision. So we say retain profits if you can earn, the company can earn greater than expectation of shareholders. Retain profits if you can earn greater than shareholder expectation. You understand? This is what we say R is greater than B. You read Walter model. In Walter model, you'll study this. In Gordon model, you'll study this. In dividend decisions. So this B is nothing but, cost of retained earnings. This is nothing but cost of capital, cost of equity, or cost of retained earnings, you say. So in dividend decisions also, now student will get, a kind of mental assault. Oh, that means this cost of capital is not only relevant for financing decisions, it is relevant for financing decision. Yes. It is relevant for investing decision. Yes. It is relevant for dividend decision. Yes. Oh my God. This is the importance of cost of capital. This is the importance of cost of capital. You understand? You understand? Now put the heading 1 cost of debt. Put the heading cost of debt. So till now I have just given you the introduction. From now we'll do, problems, and we'll see how to calculate cost of debt, how to calculate cost of equity, how to calculate cost of retained earnings, then cost of preference shares, then weighted average cost of capital, then advanced problems. Okay, so till this, whatever we have discussed, any doubts? Do you have any doubts up to this?